Every ounce of silver just took a hit, and the most aggressive buyers on the planet didn't even flinch. Price slipped into the mid-75s, the easy dip level, and the market answered with something scarier than selling: silence. No stampede, no panic buying, no heroic bid to save the chart. And that absence is the leak. It suggests the crowd isn't planning to defend $75. They're positioning for something lower. I'm Zaryab Munir, and this is Hidden Power Archives. Here's what happened, clean and simple. Silver ripped to triple digits earlier in 2026, got crowded, got leveraged, and then the floor started to give way. The first drop shook out tourists. The second drop forced liquidations. And now we're at the point where the smart money is supposed to step in, but instead they're waiting. When the usual dip buyers refuse to buy the dip, it doesn't mean silver is dead. It means the next move is being engineered by psychology, positioning, and timing. You're being trained to think like this. It's down a lot, so it's cheap. That's the retail reflex. But markets don't bottom because something looks cheap. Markets bottom when the last forced seller is gone, when the last weak hand is out, and when the last trader who swore they'd buy lower finally gives up and buys higher. The bottom is not a price. It's an emotional event. Right now, silver around $75 feels like a discount if you're staring at the old highs. But the market isn't comparing silver to the old highs. The market is comparing silver to the dollar, to yields, to liquidity, and to the next headline that can flip risk on in 1 hour and smash safe haven demand in the next. That's why the dip didn't get bought. Let's rewind the chain reaction, because this didn't happen in a vacuum. There were catalysts. Not mystical ones, mechanical ones. One piece was geopolitical risk cooling off, at least on the surface. When headlines start hinting at diplomacy, the fear premium that props up metals can leak out fast. It doesn't matter whether the world is actually safer. Markets trade perception. If traders perceive less immediate risk, they rotate out of protection and into yield. Silver is protection with no coupon. In a world obsessed with yield, that's a problem. Then you had softness in key physical demand windows. Silver is global, but certain regions matter because they absorb real metal, not paper promises. When those buyers hesitate, even for seasonal reasons, it removes a layer of support that usually catches corrections before they become free falls. And then the quiet killer, thin liquidity. When liquidity thins out, price moves become exaggerated. A normal amount of selling pushes price too far, too fast, because the order book is empty. A small shove creates a big drop. This is how you get crashes that feel irrational. They're not irrational, they're illiquid. Now combine those three forces: less fear premium, softer near-term physical bids, and thinner liquidity. That's how you slide into a level like $75 without a clean fight. But the deeper story is what happened next, what didn't happen next. Because in a normal bull cycle, a 30 to 40% pullback invites hunters. Institutions rebalance, value players accumulate, industrial buyers hedge, retail stacks. You usually see a visible change in behavior. Volume spikes, bids stack, volatility compresses. Instead, silver got hesitation, light participation. That uncomfortable, everyone's watching, no one's buying vibe. So why the hesitation? Start with the dollar. When the dollar strengthens, silver becomes more expensive for the rest of the world. That shrinks the buyer pool instantly. It's not ideology, it's math. A stronger dollar is like raising the global sticker price without changing the number on the chart. Now pair the stronger dollar with real yields. When real yields rise, the opportunity cost of holding silver rises. If a large fund can get a real return parking money in government paper, silver has to compete harder. Silver doesn't pay interest, it pays optionality. It pays chaos insurance. But if chaos is perceived to be contained and yields are attractive, the short-term incentive to hold silver weakens. That's why Fed uncertainty is poison for metals in the short run. The market can handle hawkish. The market can handle dovish. What it hates is maybe. If traders can't price the path of rates, they reduce risk. They de-lever. They cut exposure. They wait. And waiting removes bids. Then comes the part most people don't want to talk about, because it feels unfair: forced liquidation. When silver ran earlier in 2026, leverage piled in. Futures, options, margin accounts. Leveraged longs that looked genius on the way up. But leverage is a deal with the devil. You're not just betting on direction, you're betting on staying alive long enough for direction to matter. When price drops fast enough, brokers don't ask you what you believe. They close you out. That selling is not opinion. It's a margin algorithm. And forced selling creates cascades. Price drops trigger margin calls. Margin calls trigger liquidation. Liquidation triggers more price drops. The chart becomes a staircase down. Potential buyers see that and say, "I'm not catching that." They wait for the cascade to finish. The problem is, everyone waits at the same time. This is why you can get a market that falls with almost no resistance. It's not that nobody likes silver. It's that too many participants are staring at the same risk. The waterfall isn't done. Now layer in technical structure. People love to treat support levels like magical force fields. They're not. Support is just a place where buyers previously showed up. If buyers don't show up again, support is a myth. $75 is one of those myth-testing zones. It's a level that should attract bids because it's psychologically neat and technically visible. But support only matters when behavior confirms it. If behavior is timid, support becomes a trapdoor. And below $75, the big psychological magnet is $70. Round numbers have gravity. They attract orders. They attract headlines. They attract arguments. But here's the dark twist. The market knows you're watching $70. The market knows millions of people have "I'll buy at $70" written in their heads. So what happens in markets when everyone plans the same entry? Often, price tags the level, wicks through it, triggers stops, triggers fear, and only then bounces, after it has punished the maximum number of would-be buyers. The market is not a vending machine. It's a stress test. If $70 cracks cleanly and fear accelerates, the next zones people whisper about are $68, $65, even $60. Not because those numbers are destiny, but because that's where the next clusters of old volume and old psychology sit. Here's the key point. None of this means silver is worthless. It means the short-term market is controlled by paper dynamics, positioning, yields, the dollar, and liquidation, more than by the long-term supply story. And that's where the confusion traps people. They mix timelines. Industrial demand doesn't behave like retail demand. An industrial buyer doesn't wake up and say, "Oh wow, spot is down 10%, buy double." Industrial procurement runs on contracts, schedules, and risk controls. A solar manufacturer can't just YOLO into spot metal because the chart looks juicy. They're locked into planning cycles. They respond slower. So during a sharp, paper-driven sell-off, the industrial bid doesn't surge fast enough to stop the fall. It's steady, not reactive. The reactive buyers are investors and speculators, exactly the groups being spooked by yields, the dollar, and liquidation. Now let's talk about the weird divergence that makes this moment dangerous for both bulls and bears. Physical tightness versus paper weakness. You can have a world where actual physical availability is tight, inventories are not comfortable, and supply growth is constrained, while the paper price still drops because paper can create supply with contracts. Paper can flood the market in seconds. Mines cannot. That divergence can persist longer than you think. It can also resolve violently. Because when paper sells off too far relative to physical reality, arbitrage wakes up, premiums speak, delivery pressures build, and suddenly the paper market has to respect the physical market again. Watch physical premiums. When spot drops but physical products don't get cheaper, that's a signal. It means real metal isn't being dumped the way paper is being dumped. It means the supply chain isn't relaxed even though the chart looks panicked. That's not a guarantee of a bottom, but it's evidence that the paper crash and the physical world are not perfectly aligned. Now, why would big buyers refuse to defend $75 if the physical story is tight? Because big buyers aren't just buying cheap metal, they're buying timing. They want confirmation that the forced selling is done. They want confirmation that the dollar isn't about to spike again. They want confirmation that the Fed narrative isn't about to reprice yields higher. They want confirmation that $70 won't break and cause a headline-driven stampede lower. In other words, they're waiting for a catalyst. And the catalyst doesn't have to be good news. It just has to change the incentive structure. There are a few catalysts that can flip silver from avoid to accumulate fast. One is a clear shift in central bank tone. If messaging turns decisively more dovish, if the market starts believing rate cuts are coming sooner, faster, or deeper, the dollar can weaken, real yields can soften, and silver suddenly looks attractive again. That's the classic precious metals ignition. It's not romance, it's rates. Another is geopolitical risk reaccelerating. Peace headlines remove the fear premium slowly. Crisis headlines add it back violently. Safe haven flows are asymmetric. That's why silver can grind down for weeks and then explode in days. A third catalyst is the physical market tightening to the point where paper can't ignore it. This can show up through persistent premiums, stressed delivery windows, and industrial hedging activity that starts to creep back in. When industrial players start forward buying, they don't do it loudly. They do it quietly, until it's suddenly obvious because the available supply disappears. Now let's address the elephant, the long-term fundamentals that keep pulling people back to silver even after gut-punch corrections. Silver is not just a precious metal, it's a strategic industrial input. Solar, electronics, medical applications, electrification, advanced components. This isn't a maybe story, it's the direction of the world. Demand doesn't move in a straight line, but the trend is real. Meanwhile, supply is not elastic. You don't turn on a mine like flipping a switch. Even in a best-case scenario, new projects take years. Ore grades have been pressured over time, meaning you have to move more rock for the same metal. Costs rise. Permitting gets harder. Jurisdiction risk grows. Capital discipline limits growth. So the long-term bull case is basically a physics and geology argument. Demand wants to climb. Supply struggles to keep up. That doesn't mean the chart can't drop. It means drops can become opportunities if your time horizon is longer than the liquidation cycle. But you still need to respect the path. Silver is famous for doing one thing better than almost any asset: humiliating both sides. It can crush bulls with deep drawdowns, and then rip so fast bears can't cover. So what's the real meaning of "nobody bought the $75 dip"? It's not a prophecy. It's a signal about positioning. It tells you the market is still in a phase where fear is stronger than greed, where the dominant mindset is protect capital, not deploy capital, where people would rather miss the first $5 of a rebound than catch the last $5 of a drop. That mindset can persist. It can also flip overnight. So here are the three roadmaps the market is flirting with right now. One path is the breakdown path. Silver loses $75, tests $70, and if $70 breaks, the market hunts for the next panic zone, $65, $60, until forced selling ends and real buyers finally step in. This path is fueled by dollar strength, stubborn yields, and liquidation momentum. The second path is the reversal path. Silver holds in the $70-$75 zone, the selling exhausts, and a catalyst appears: Fed tone shift, risk event, physical tightness, bringing bids back. Price stabilizes, shorts get nervous, and the recovery pushes toward $80 and beyond. This is the spring compresses, then releases scenario. The third path is the torture path. Silver chops sideways for weeks in a range, bleeding attention, draining traders, and building a base nobody wants to trade. This is where most people quit. And ironically, this is where long-term accumulators thrive, because time, not price, does the work. Now I want you to do something most people refuse to do. Stop asking, where will silver be next week? Start asking, what would have to be true for the next big move to happen? Would the dollar need to weaken? Would yields need to soften? Would inflation expectations need to shift? Would risk need to spike? Would physical premiums need to scream? Pick your trigger, then watch for it. That's how you stop being emotionally dragged around by the chart. And here's a crucial behavioral trap: the "I'll buy lower" fantasy. A lot of people claim they want $70. Many will freeze at $70 if it arrives fast, because if price is slicing through $70, it won't feel like a gift. It will feel like danger. Your brain will whisper, wait for $65. And if $65 comes in panic, your brain will whisper, wait for $60. That's how people end up never buying, then chasing at $90 when it feels safe again. So if you're going to participate in this market, you need a plan that doesn't depend on perfect timing. That's not advice to buy blindly. It's advice to be honest about your own psychology. If you're long-term, you scale. If you're short-term, you respect stops and volatility. If you're leveraged, you understand leverage is not a position, it's a timer. Now let's talk about one more signal the crowd underestimates: relative value inside the precious metals complex. When gold stays elevated and silver gets crushed, the gold-to-silver relationship stretches. Historically, that stretch can create conditions where silver becomes the catch-up trade once pressure eases. It doesn't mean silver must rebound tomorrow. It means there can be a window where silver is historically cheap relative to gold, and that window can close fast when sentiment turns. You can also watch broad investor behavior through vehicles that hold metal exposure. When panic is real, you usually see violent exits, not just price drops. If the selling is mostly in leveraged paper, while longer-term holders stay steadier, that suggests the market is purging leverage more than abandoning the entire thesis. Again, not a guarantee, but a clue. Now here's the part most analysts won't say out loud because it sounds dramatic, but it's the truth of markets. The absence of dip buying is itself a weapon. When buyers don't show up, it invites sellers. It tells shorts they can press. It tells funds they can reduce risk without paying a premium. It turns a correction into a trend. But it also loads the spring. Because every seller needs a buyer eventually. Every liquidation ends. Every downtrend reaches a point where the marginal seller is exhausted, and price can't fall without new bad news. That's when reversals start. Not when the story is popular, but when the pain has peaked. So the real question is not, is silver bullish? The question is the liquidation cycle finished? And that's why $70 matters. Not because it's magical, because it's where psychology may snap. A clean hold of $70 with stabilizing behavior can attract real money. A sharp break of $70 can trigger the final flush that creates the kind of fear that, ironically, sets up the next opportunity. Before we close, I want your input, because how you answer tells me where the crowd is positioned. Are you waiting for $70 to buy? Or are you already scaling in at $75 because you think the market is setting a trap for late buyers? And second, do you think this sell-off is mostly paper liquidation? Or do you believe it's the start of a deeper macro unwind that drags silver much lower? Drop your answer in the comments. I read them, and the crowd's positioning is data. Now a quick, simple CTA, because it matters. If you want more breakdowns like this, subscribe to Hidden Power Archives. Short, sharp, and no fluff. Here's the bottom line. Silver didn't just dip. It tested the integrity of the buyer base, and the buyer base hesitated. That hesitation is the inside leak. It suggests the market is either preparing for a deeper flush or loading a spring so tight that when the catalyst hits, the rebound will be violent. Don't let the chart hypnotize you. Watch the drivers: dollar, yields, liquidity, liquidation, and physical signals. When those start to shift, price will move before the headlines catch up. And if $70 is coming, it won't arrive with a ribbon on it. It will arrive with fear. The market will dare you to buy when it feels worst. Most people won't. That's why the move that follows could be the one nobody is emotionally prepared for.